Finance is filled with these hidden rules, these invisible forces that shape multi-billion-dollar decisions. Today, we're going to use a really powerful idea to crack a puzzle that has stumped experts for decades.
And that puzzle starts with a simple question. If a company wants to go public, an IPO, what's the absolute fairest way to set the price for its shares? You'd probably say an auction, right? Just let the market decide. It sounds perfect. In theory, it's the ideal solution. But in the real world, it's a completely different story. A total mess, actually.
And look, this isn't just a one-off thing. This is a real global pattern. Country after country tried using auctions for their big IPOs, and pretty much every single one of them has given up on it. So what on earth is going on here? Why does a method that seems so fair on paper fail so spectacularly in practice?
All right, so let's dive right into this. We're calling it the IPO auction mystery. And it's not just some academic quirk, it's a huge real-world puzzle. And it tells us that something much deeper is at play.
So, to figure this out, we need a new way of looking at the problem. We need a new lens. And that lens is game theory. This is the key that unlocks why people and companies make the choices they do when what they get depends on what everyone else does.
So what is game theory, really? Well, forget chess or poker for a second. Think bigger. It's the study of strategy in any situation where you can't just make a choice in a vacuum. The outcome of your move depends entirely on what everyone else in the game is about to do. It's all about thinking ahead.
And that leads us to this huge idea, the Nash equilibrium. The easiest way to think about it is as the point of no regret. Imagine you're in a game, you've made your move, and you see what everyone else did. If you can look at the outcome and honestly say, you know what? Given what they did, I made the best possible move, then you're at a Nash equilibrium. Nobody can do better by changing their mind alone. It's where the game settles.
Okay, so now that we've got our tools, game theory and Nash equilibrium, let's get back to the crime scene, so to speak. Let's use them to finally crack this case. Because the failure of IPO auctions isn't an accident. It's a totally predictable outcome of the game being played.
So why do auctions for things like U.S. Treasury bonds work perfectly fine, but IPO auctions are such a train wreck? Well, it's all about the game's setup. Treasury auctions are stable. They happen all the time, the bonds are pretty easy to value, and you have the same big professional players every time. IPO auctions, they're the complete opposite. They're rare, one-time events. Figuring out a new company's true value is incredibly hard, and the players, it's a random mix of pros and amateurs. The whole thing is just unstable by design.
And that instability creates our first huge problem. It's called the winner's curse. Imagine a sealed jar full of cash. Everyone gets to bid on it. Who's going to win? Well, it'll be the person who guessed the highest amount is inside. They win, but they've almost certainly overpaid. In an IPO auction, it's the same thing. Winning often just means you were the most wildly optimistic person in the room, and you're probably paid too much. The smart investors know this, so they get scared off.
Then there's the second killer problem, the free rider. Look, it costs a lot of time and money to actually research a company and figure out what it's worth. But in some auctions, an uninformed person can just throw in a ridiculously high bid, knowing they'll only pay the lower final market price. They get to free ride on all the hard work the informed bidders did to set that price. It's like you do all the homework for a group project and someone else just slaps their name on it. It messes up the whole process and drives the serious players away.
It really comes down to what Sherlock Holmes said. Once you eliminate the impossible, whatever is left, no matter how improbable, must be the truth. When you have the winner's curse and the free rider problem happening at the same time, you've created a game that's almost impossible to win. It becomes unstable, and game theory is the only explanation that really accounts for these strategic flaws.
But here's where it gets really interesting. This isn't just about IPOs. Once you start wearing those game theory glasses, you suddenly see these hidden strategic games playing out absolutely everywhere in finance.
Take the prisoner's dilemma. That classic model can explain why two rival companies get locked into a destructive price war, even when they'd both be better off if they just cooperated. Or signaling games. They explain why a company might pay out a massive dividend. It's not just about the cash. It's a powerful signal to the market that they're strong and healthy. And repeated games show us how trust is built over time, which affects everything. Let's make that signaling game super concrete. Okay, so a firm, the sender, decides to pay a huge dividend. That dividend is the signal. An investor, the receiver, sees this and it changes their belief. They think, wow, this company must be doing really well to afford that. And that new belief leads to an action. They buy the stock. You see? It's a whole strategic conversation, but it's being played out with millions of dollars instead of words.
So, we've seen how the game works. But here's the thing. The game is changing. Fast. The players aren't just people in suits anymore. There's a whole new set of players taking the field, and they are rewriting the rules as they go. First, you've got AI trading agents that can run through thousands of strategies in the blink of an eye. Then you've got decentralized finance, or DeFi, where the rules of the game are literally baked into the code itself. There's no central authority. And of course, you have the whole world of blockchain and tokenized assets, which is creating entirely new game boards we've never even seen before.
So yeah, the fundamental principles of game theory, strategy, signals, equilibrium, they all still matter. But when the players are hyperfast algorithms and the rules are unbreakable lines of code, the game becomes infinitely more complex. And it leaves us with this one huge looming question. In this new financial world, who actually understands the rules well enough to win?